Welcome to Money Matters. I'm DCrowell, and I'm the Principal Senior Loan Officer with Mortgage Network. I'm usually joined by my co-host Emily Johnson of Polaris Capital. She is away this week for the beginning of the holidays, so I'm going to treat you to my best understanding of what's going on with our local economy, the national economy, and the world economy. Money matters. All the intersection of the crazy, complicated world and what its likely impact is on you. So that's a broad statement. We make it every week. We do our best to focus on this or that that is going to show some glimmer of understanding, hopefully, of what's going on in the world of money and money matters. I'll start today with interest rates, since interest rates are near and dear to my heart. I'm a mortgage lender, and my world is consumed day after day with little ticks up and down in the interest rates. I'm consumed with speculation and conversation every single day as to what the rates are going to do, what they've done, what can we look forward to in 2018, and so forth. So, interest rates. First of all, interest rates are part of a larger subject, which is fixed income securities, U.S. Treasury bonds and U.S. Treasury bills, big mortgage-backed securities. All of them are a multi-trillion-dollar industry, or a packet of assets known as fixed income securities, and they all represent investments that can be made that give a promised rate of return. So for $100 invested, you get 3.12% back on this or that treasury. You get 3.625% back on this or that mortgage security. And you get it for the life of the security. If interest rates go up or down in the world, then the value of that $100 bond that you bought goes up or down with it. So here's the easy example. If you buy a $100 mortgage-backed security through your investment portfolio, and you pay $100 for it, and you get, let's keep it simple, you get a 3% return on that. And the economy gets hot, and interest rates go up, then the value of that bond goes down. So you're still getting your 3% on the $100 that you invested. You're getting that 3% for the life of the bond. If it's a 10-year bond or a 10-year treasury bill or a 10-year mortgage-backed security, you're still getting your 3% per annum on the $100. But if rates go up, and then the value of that bond goes down. Why? Because you could now invest the same $100 and get 4%. So the 3% bond that you hold is less valuable because there's something else out there that is of equivalent security that you could get a better return on. So the value of the $100 bond might go down to $90. You're still getting the $3, but the value of it, were you to cash it in, would go down to $90. Conversely, if rates in the world go down, let's say they went down, you invested it and got a return for your $100 of $3%, and rates went down to 2%, then that means that anybody new coming into the market is going to get a lower rate of return than the 3% that you're currently getting. That means they could buy your bond and would be willing to buy your bond for more money. So your bond is suddenly worth more than you paid for it. It's worth $110 or $120. So you can see the relationship. The value of the security is dependent on the rate of return that it gives, and that value, the value of the security, changes literally every day, just like a stock. So there's the stock market, which is, everybody is well aware. The stock in Apple is changing every day. The stock price of IBM is changing every day. Well, in fact, the value of bonds is also in a very similar way, changing every day. Now comes the next piece of interest rates. Money is worth more. Investors will pay you more if the money is invested over a long period of time. So every single one of you has been into a bank lobby and seen that a 3-month CD pays a lower interest rate. The bank will give you a lower interest rate for a 3-month CD than for a 1-year CD, than for a 3-year CD, than for a 5-year CD. In other words, they'll pay greater interest rates if you give them the money and promise to let them have the money for a longer period of time. That over a much longer period of time is also the case. So if you're borrowing, if you're lending money, borrowing money for a month or 3 months or 6 months or a year, the interest rate is at its lowest. If you're borrowing money for a 30-year fixed rate loan, that money is at the highest. And for each term in between, for each period of time in between, the interest rate goes up slightly. So a typical yield curve, it's the yield on the money, the interest rate paid for the money. A typical yield curve is a positive yield curve over time, with short-term lending and borrowing at the cheapest, and long-term lending and borrowing at the most expensive. That's called a positive yield curve. At present, we have a very flat yield curve. The yield curve, the short-term money is almost the same price as the long-term money. Give you a simple example. If you were to get a home equity line today, a home equity line is a classic form of borrowing short-term, because the interest rate changes every time the Fed funds rate changes. It's based upon the prime rate of interest and fluctuates. A home equity line from most banks today is going to be 4.25%. That's at the short end of the yield curve. That's at the shortest period of time. That varies month to month. The long end of the yield curve, which is 30-year fixed rate mortgages, today is the 16th of December that I'm recording. When I walked in here, our interest rate was 3.99% and almost 3.875%. So the yield curve was not only flat, but it was a little bit less than flat. It was actually a negative or a reverse yield curve. This is a phenomenon that we don't see very often. It's a rarity in the financial business. Normal yield curve looks like this, with 2% here, and 4% here, or 3% here, and 5% here. Rarely we see a flat yield curve, and we're starting to tilt into a negative yield curve. Now this has all kinds of, this first part of the show has been rather boring, I'm aware of that, but this has all kinds of indications and implications for the state of the economy, and it's a good indicator of where things are going. So in the second half of the show, I'll branch out and elaborate on what this tells us about the economy. See you back soon. This is DCrowell for Money Matters and for Mortgage Network.